Good evening, students. I hope you have revised what you have done in the last lecture on capital gains. So, let me just quickly revise with you. In the last class, we had talked about the general charge under 45.1. 45.1 speaks about when the capital gain would be chargeable. When it is chargeable on transfer of a capital asset, and when it would be in the previous year in which transfer takes place. We had seen the definition of capital asset under section 240, right? Remember, it is defined in an exclusion, and then there are certain exclusions to the exclusion, meaning they will be included. So there are certain exclusions, there are certain inclusions. What were the exclusions? Quickly, do you remember? So stock in trade was excluded. And what else was excluded? The personal property, personal movable property, right? And then some gold deposit bonds and rural agricultural land. Remember? And what was included in that? So for FPIs and FIIs, stock in trade is always considered as capital asset, irrespective of whether it is held as stock in trade or not. And from personal movable property, what was excluded? Jewelry, work of art, paintings, drawings, all that are included within the definition of capital asset. What is rural agricultural land? The one which is not situated within the municipality limit where the population exceeds 10,000, or urban land. What is urban land? There were limits to it. There was a limit of distance as well as limit of population. Both needs to be satisfied simultaneously. Then we had seen what is long-term, what is short-term capital asset. There are different period of holding criteria for different nature of asset. 12 months criteria exist for listed equity share, for units of UTI, for securities listed on recognized stock exchange in India, zero coupon bond. 24 months criteria for unlisted shares and immobile property. 36 months for other assets. Do you remember that? Then what we had seen apart from that transfer of capital asset, we had seen the definition defined under 247. It includes sale, extinguishment, relinquishment, compulsory acquisition of land, conversion of capital asset into stock in trade. All that was included in the definition of transfer. Remember, then we had dealt with the specific charges. Specific charges first on receipt of insurance compensation. Right? When it will be taxable? When the insurance compensation is received, when the asset is destroyed by natural calamity, in the year in which compensation is received. And period of holding and indexation was till the year when the asset got destroyed. Remember? Then we had seen conversion of capital asset into stock in trade under 45.2. So in that particular case, when a capital asset is converted into stock in trade, when the taxability would happen? In the year in which the stock in trade is sold under 45.2. And the FMV would be taken as full value of consideration, FMV as on the date of conversion, and the balance would be taxable under PGBP also, the selling price minus the cost which is taxed as FMV. Remember? Then we had seen the situation of the reverse scenario when the capital asset, when the stock in trade is converted into capital asset. So in that case, when it is converted in that particular year itself, PGBP would happen. And the FMV minus the cost would be taxed under PGBP, and the balance would be considered under capital gain. The selling price minus the FMV taxed under PGBP. Remember? Then we had seen transfer of capital asset by a partner to the firm. It will be taxed at the value. The FVC would be considered as the amount recorded in the books of the firm, and it will be taxed in the year in which transfer takes place in the hands of partner. Under 45.4, we had seen dissolution. Dissolution, at that point in time, the amount given to the partner, the value of the asset, FMV as on that date, will be taken into consideration as FVC, and it will be taxable in the hands of firm, right? We had seen dissolution also includes retirement. But What will not be considered as capital asset is the relinquishment of the rights in the partnership by a partner. Remember all those things? Then we had seen compulsory acquisition of land. When it will be taxable when the first installment or part or full installment is received as compensation on compulsory acquisition. Enhanced compensation will also be taxable and it will have the same nature as that of the original asset. And the indexation and period of holding will be till the date when the asset was compulsorily acquired. Interest on compensation will be taxable in the year. Interest on compensation will be taxable under EFOS, subject to 50% deduction. Is it clear? Any doubts you have with respect to previous lecture? So this is, I have revised entirely what I had done in the last class. If you have any doubts concerning last class, you can ask me now. Otherwise, we'll proceed to the next part of it now. Any questions? Ambika, for FII, yes, it will be always capital asset. Yes, Ambika, right. Any other doubts? If there are no further doubts, then let's move ahead to the next section under specific charge. 45(5)(a), joint development of the property. Capital gain in case of joint development agreement. Now, what is that? Let's try and understand. So, what usually happens is, sometimes these landowners are there who may be, just having the land in their hand. Now, what do the builders do is, builders usually ask for the land from the landowners and then they construct the land on that, then they construct the building on those particular land. So, in this particular case, what happens is, say for example, there is owner of land, right? There is owner of land or building. He would transfer land or building to the real estate developer under a registered agreement. Right? Now, when you are transferring the land to the real estate developer for constructing buildings, obviously you would transfer it in guise of receiving some amount of consideration. What could be that consideration? So consideration will be in the form of, what these builders do is, they give the share to the owner of that land. They give the share in that land or building. Share in that land or building, which is constructed by the builder. Plus some additional monetary consideration. Are you clear? So what happens is, when the owner of the land will give the land to the real estate developer, the real estate developer would construct the buildings on it, right? And what he would do in those buildings, he would give some share, like some units of that particular building or some flats in that particular building would be given to the owner as a consideration for giving the land. So you are giving the land and you are receiving some flats in the constructed building. Plus, you may get some additional monetary consideration in cash. Now, here there is a transfer which is happening of land or building. And in return, you are receiving some amount of consideration. What do you think? Whether there is a transfer under section 247? Yes, there is a transfer in this particular case of the land or building by the owner to the real estate developer. Now, this transfer is taxable under the head capital gain, right? Now, what was happening was that this particular transfer of property by the owner of the land to the real estate developer, according to you, should be taxable when? I need your answers in the chat boxes. When do you think this transfer of land or building should be taxable in which particular year? What do you think? Give me quickly the answers in chat boxes. When do you think it should be taxable? When do you think will be available the benefit? Oh, sorry, taxability will happen in which particular year? Quickly tell me in chat boxes. The year, Anjali, you're saying in the year in which the construction took place. Ambika, you said when the consideration is received. Chavi, you are saying when the project is completed. Yes. Raman, you are saying completion certificate is received. Why do you think when the completion certificate is received? Why do you think when the completion certificate is received? When the land is transferred, Muthu Lakshmi. Preeti, you are saying when the property is given to develop. Jayashree, in the year in which transfer takes place. Sandeep, on completion. So what is the correct answer in this particular case? Why do you think the completion? The correct answer is when the completion certificate is received. But why do you think in the year in which completion certificate is received is the correct answer? Here, Raman Sachdev, it's the legal document. Yes. Yes, Sandeep. Correct. Any other answers? So the important point here is that see 45(1) says in the year in which transfer takes place. Correct? Now, if you go and see the definition of transfer under 247, let me take you to the definition of transfer under the Act itself. One second. Let's look at the definition of transfer to understand why in the year in which completion certificate is received, the taxability will happen. So what does 247 tells us? Let's look at it. See, let's read this point. 247 says transfer in relation to capital asset includes any transaction involving the allowing of the possession of any immovable property to be taken or retained in part performance of a contract of the nature referred to in Section 53A of Transfer of Property Act. So it says that any transaction involving the allowing of the possession of any immovable property to be taken or retained in part performance of the contract. Now understand here the part performance of the contract is happening when you're giving the land and the registered agreement is entered into. That is just the part performance of the contract. It is not the full performance. So ideally, as per section 45(1), if there was no specific section, as per section 45(1), the transfer would have taken place in the year, the capital gain would have occurred in the year in which transfer of land, transfer of land takes place by the owner to real estate developer. Correct? So that would have been a correct answer if we go through as per section 45(1), because 45 provides that capital gain shall be chargeable to tax in the year in which transfer takes place. Correct? So in that particular case, in case such a scenario, execution of the joint development agreement between the owner of immovable property and the real estate developer triggers the capital gain tax in the year in which, in the hands of the owner, in the year in which the possession of immovable property is passed on to the developer. Right? So, but that, if you notice, will it not cause hardship to the owner of the land or building? Because he will receive this consideration only after a couple of years. So say for example, he has transferred the land in 2001. The consideration might be received in say 2005 because it may take 4 years for the buildings to go on. Right? So in that particular case, there will be hardship caused to the owner of the land if capital gain tax is imposed on him at the time of transfer. So to provide the relief to the owner of the land, section 45(5)(a) is introduced. What does 45(5)(a) says? 45(5)(a) says that it will be taxable in the year in which, so transfer in the year in which certificate of completion is issued. Certification of completion is issued by competent authority. Are you getting this one? So did you understand why completion certificate date is taken under 45(5)(a)? So 45(5)(a) is a specific charging section. It overrides the general charging section. It says the taxability would happen in the year in which certificate of completion is issued by the competent authority. So what will happen? Once the completion certificate is issued, only then this building could be handed over to the owner of that particular land. Because only after completion certificate is issued, the builders can pass on the land. Builders can pass on the property to the buyers. So only in that case, the taxability will occur in that particular year. Is it clear? Now, they also provide as to what will be the full value of consideration. So, what will be the full value of consideration in this particular case? What you are receiving in consideration is the land and the constructed building thereon, right? So, you are given the land and you are receiving a flat in the building, right? So how will you determine the value of that building, what you are receiving? So full value of consideration would be SDV, stamp duty value of share in land or building in developed project as on date of issuing completion certificate. Plus what? Additional monetary consideration if you receive it. Is it clear? So this will be your full value of consideration. Stamp duty value of the particular flat which you are getting in the developed project as on the date of issuing completion certificate plus additional monetary consideration if any. Is it clear? Any doubts till now? Did you understand this concept? Any doubts you have? Okay. If there are no further doubts, let's try and understand one step further. Now, what if this particular this particular share in the building is transferred before the issue of completion certificate? Now, quite possible, I have entered into the agreement with the real estate developer. I am the owner of land. I am certain that I will get a particular flat in this particular building which is being developed by that developer. Now, even before the building gets completed, I transfer that particular flat to a buyer outside in the market. Now, before the completion certificate is received, the share in the building is transferred. So, if the share being land or building is transferred before issue of completion certificate, then the taxability will be how? Taxability will be as per 45(1). Then it will happen as per normal provision, capital gain under section 45(1). in the year in which transfer takes place. Then you will not have 45(5). 45(5) will come into picture only when you hold on that particular building till the time the completion certificate is issued. But if before issuing the completion certificate, you transfer your land, if you transfer your building, then in that case, the taxability will happen under normal provision only. Then you will not get the benefit of 45(5). Are you clear? So then in that particular case, the taxability will be in previous year in which transfer takes place. Is it clear? And what will be your full value of consideration then in that particular case? Because you have received in consideration your building, right? You have received the consideration in your building. So in the form of building. So what will be your full value of consideration? Because if 45(5) was applicable, full value of consideration was SGV of share in land or building, right? But now 45(5) is not applicable. So what will be your full value of consideration? Full value of consideration will be SGV as per section 50C. Because then normal provisions will apply. Is it clear? And say for example, if the share in building is transferred after issue of completion certificate, then in that case, your cost of acquisition. So I'm saying when the share is transferred, if the share is transferred after the completion certificate is issued, then your cost of acquisition will be this. Because this is already taxed now. So what you're getting is taxed. And once you transfer your building, then in that case, cost of acquisition will be FVC as per section 45(5)(a). Clear? So once you transfer your land, once you transfer your building, after issuing the completion certificate, your FVC will be the amount which you will receive and the cost of acquisition will be as per 45(5)(a). Is it clear? And on the cash component, on this additional monetary consideration, the TDS will apply under section 194 IC. TDS will apply under section 194 IC on this particular amount, on the cash consideration. The builder will have to deduct the TDS under section 194 IC. Clear? Any doubts you have? Did you understand this concept well? Ambika, if there is some legal dispute between the owner, then in that particular case, the building might not have been transferred. We do not know the consequences. Then the taxability would get deferred till the time your building gets transferred to you when you receive the completion certificate. Sumit, you are asking, in case of subsequent sale of share of developed property, what will be the FVC? The amount which you will receive. The amount that you receive from the third party buyer, that will be your FVC. Ambika, you're asking, share transferred is before COC by the owner to other third party. Is this situation is covered here? Yes, that's what I said. That is the situation what we have talked about here, right, Ambika? This particular situation, if share or building is transferred before the issue of completion certificate. right? So that is what covered here. Any other doubts? Any other doubts? What if few flats are transferred before completion certificate? So, Preeti, as I said, if few flats are transferred before completion certificate, then in that particular case, the capital gain would be as per section 45(1). It will not be as per 45(5)(a). Clear, Preeti? Any other doubt? Let's solve a sum on this. You will have to solve. I'll give you the sum that will make your understanding very much clear. So let's try and solve the sum on this. Mr. P was owner of freehold land. In April 2019, he entered into a collaboration agreement with Lodha Builders for developing the property. According to the terms of the agreement, Lodha Builders were to develop construct and put up a building consisting of 4 independent floors. Mr. P handed over to Lodha Builders the physical possession of entire property. For the limited purpose of development. Lodha Builders was to get third floor plus undivided interest in land to the extent of 25% for its exclusive enjoyment. The remaining floors were to be handed over to Mr. P after construction. Cost of construction of each floor was rupees 1 crore. Which was borne by Lodha. In addition, a further amount of rupees 5 crore was payable by Lodha to Mr. P as consideration against rights of Mr. P. Completion certificate of ground first and second floor was received on 31st March 21. SDV as on said date was rupees 50 lakhs for ground, 60 lakhs for first and 75 lakhs for second floor. You are required to discuss and resolve what is the year of chargeability. You need to tell me. So, you need to give me the answer for Is the video now visible to you? Students, could you please reply in the chat box quickly? Is there any problem with the video? Students, please reply in the chat box. Okay, perfect. It's visible. I'm really sorry for some technical glitch. I'll repeat again. So here, those who missed the video, I'll repeat for them again. Here, when Mr. P is transferring to Lodha Builders, at that point in time, the capital gain would not arise. It will arise only when the completion certificate is received as on 31st March 2021. Clear? And what is the stamp duty valuation on that date? It's 50 lakh plus 60 lakh plus 75 lakh. That will be your full value of consideration. Plus, you would also add here the monetary consideration, which is rupees 5 crore. Is it clear? Are you clear with this JDA concept? Do you have any doubts? If you want, you can ask me right away before we proceed further. Any doubts? Did you understand this concept well? Do you want me to repeat it? Any doubts with respect to this concept? If no doubts, please just tell me in the chat box that if you have understood this concept well. Let me quickly summarize it. So, here is a chart for that. Individual or HUF entering into a specified agreement for the development of project. Is the individual or HUF transferring his share in the project after the date of completion of certificate? If the answer is yes, capital gain tax liability would arise in the previous year in which certificate of completion is issued by competent authority. If the answer is no, is the individual transferring on or before the date of issuing of completion certificate? If yes, capital gain tax liability would arise in the previous year in which the property is handed over to the developer. Is it clear? If it is transferred after the completion certificate, then in the year in which completion certificate is issued. Stamp duty value of his share on the date of issue of completion certificate plus cash consideration would be a full value of consideration as per 45(5)(a). And that will be deemed to be your cost of acquisition in case of subsequent sale of share of developed property. Is it clear? Any doubts with respect to this? Any doubts? If not, shall we proceed further? Okay. So let's move to another section, which is 46. Capital gain on liquidation of companies. Now, what happens when a company is liquidated? Let's try and understand that. So when a company is liquidated, what happened? There are two aspects to it. What are the two aspects? A, the company which goes into liquidation. First, we'll talk about that. First, we'll talk about the company in liquidation. Now, this company in liquidation will either sells its capital asset in market and then pay off by cash to the shareholders. When it sells its capital asset in the market, this will be considered as taxable transfer under section 45(1). Clear? However, if it directly transfers its capital asset to shareholders, this will be not taxable as per section 46(1). Is it clear? So if the company transfers the capital asset to shareholders on liquidation, it will not be taxable as per section 46(1). Clear? Part B. In the hands of shareholder. What will be the implication in the hands of shareholder? Let's try and understand that. So in the hands of shareholder, the shareholders would give what to the company? Transfers the shares. On liquidation, the shareholders will give the shares and will receive consideration in form of capital assets, cash, whatever. Okay, so they will receive the consideration in the form of capital assets because they are giving away or relinquishing their rights in the company. The company is getting liquidated. Clear? Now, this will be considered as taxable transfer. Taxable in the hands of shareholders. Is it clear? What will be the full value of consideration in this particular case? So, full value of consideration will be FMV of assets received plus money received minus deemed dividend under section 222C. Do you remember? We will also deal with deemed dividend in the E4's class, but the deemed dividend under section 222C, what does it say? And section 222C says that if the company distributes the assets on liquidation, then to the extent of accumulated profits, that will be considered as deemed dividend in the hands of shareholder. So if the liquidating company distributes the capital assets to the extent of accumulated profits, that will be considered as deemed dividend. To the extent of accumulated profits, meaning to the extent of reserves and surplus with the company. Over and above reserves and surplus, if it distributes its capital assets, it will be taxable as capital gain. So therefore, what is taxed under deemed dividend under 222C would be reduced from capital gain consideration, because you cannot double tax an amount, right? So you would reduce the deemed dividend portion. So to the extent of accumulated profits or reserves and surplus, the capital assets which are distributed will be considered as deemed dividend under E4s. Over and above that will be considered under capital gain. Are you clear with this? Earlier, deemed dividend was taxable in the hands of company because dividend distribution tax was applicable. From this particular year onwards, dividend distribution tax has been abolished. So, now the deemed dividend would be taxable in the hands of the shareholders itself. The shareholders will have to pay the tax, but the head of income will get bifurcated. To the extent of accumulated profits, it will be taxed under income from other sources. Over and above that will be taxable under capital gain. Is it clear? What will be the cost of acquisition? Cost of acquisition will be the cost of purchase of shares. Period of holding, date of purchase till date of liquidation. Is it clear with you? Any doubts with respect to this concept? Raman, I didn't get your point. Will not reduce the cost of purchase. Where you are asking? Padmanabhan, you are asking me capital gain would arise in the hands of the shareholder only when he transfers the assets received in liquidation? Yes. No, only when he transfers the assets received in liquidation? No, no, sorry. So capital gain would arise in the year in which he is receiving the assets. Clear, Padmanabhan? Any other doubt? Is this concept clear? Is it clear? Any other doubt? Shall I give you the sum in respect of this? Let me try to give you a sum and let's see if you can answer. First, we'll revise it with a chart quickly. So this is the chart of it. Capital gain on distribution of assets by the companies in liquidation in the hands of company 46.1. Distribution is not a transfer. In the hands of the shareholder, distribution attributable to the accumulated profits deemed dividend under section 222C. And that will be taxable in the hands of shareholders as income from other sources. In the hands of shareholders and over and above that will be taxable under the head capital gain. So money received plus FMV of assets distributed minus deemed dividend will be taxed as FVC under section 46.2. Is it clear? Any doubts? Raman, for JDA, what you were exactly asking, like where you would not reduce the cost of purchase? In the last sum which we dealt, there I only asked you the question of full value of consideration. Yes, if I would ask you the question on capital gain, you would reduce the cost of purchase for sure. Sumit, you're asking if liquidator sells the assets and fund collected from this and distributed fund to company, whether company is liable to capital gain? No. As I said, when you sell the assets, that time the capital gain would come. But when you distribute that asset as a cash to the shareholders, that time there is no capital gain. Anjali, I will repeat why we have deducted deemed dividend. Muthualakshmi, yes, indexation benefit will be applicable on the period of holding. So, Anjali, why I reduce this deemed dividend? So, deemed dividend is what? To the extent of accumulated profits, to the extent you have the reserves and surplus in your balance sheet, to that extent, if you distribute your capital asset, that will count as deemed dividend. Now, once you tax the deemed dividend under EFOS, you cannot tax the same amount under capital gain. So that is why we are reducing the deemed dividend from the full value of consideration. Clear, Anjali? Is it clear? Any other doubt? Shall I give you the sum? Let me give you the sum for this. Let's try and solve a sum. Aries Cube Private Limited went into liquidation on 1st June 2019. The company was seized and possessed of following funds prior to distribution of assets to shareholder. Share capital issued on 1/4/2015, 5 lakh. Reserves prior to 1/6/2019, 3 lakhs. Excess realization in course of liquidation, 5 lakh. There are 5 shareholders, each of whom received rupees 2.60 lakh from liquidator in full settlement. You are required to tell me about the capital gains. So quickly tell me your answers in the chat boxes. Padmanabhan, the shareholder is not transferring the assets he got in liquidation. The shareholder is transferring his shares to the company, and in guise of that, is in consideration of that, he's receiving the assets from the company. Because the company is getting liquidated, the shares are getting destroyed. So he is getting, as a consideration for that, the assets of the company. So that is the reason why the capital gain is happening, because what is transferred is the shares. Clear, Padmanabhan? When he would subsequently transfer the assets, that time again the capital gain tax would come, but he would get the deduction of the cost of what the FMV of that particular asset he would get as deduction as cost. Clear, Padmanabhan? What are your answers? Chavi, you are saying the amount as the capital gain or only the full value of consideration? Ambika, no. Tell me about single shareholder, Ambika. Sumit, yes, right. Perfect answer, Sumit. No, Anjali. Raman, in the hands of company, there will be no tax. As I said, 46.1 says no taxation in the hands of company. The 5 lakhs which you are saying, the excess realization amount, that is something that is just the excess lying with the company. We do not know the amount which is sold, the capital asset which are sold by the company. Yes, for shareholders, the amount is right, Raman. But for company, there is no information given as to what amount of assets are sold. Kunal, no. Yes, Ambika, your answers are reaching me. I replied also. Chavi, FVC is wrong. Oh, sorry, FVC is right. Yes, 2 lakh is right. It's okay, Padmanabhan. I understand. Ambika, your answer is not correct for shareholders. I'm saying answer for one particular shareholder. You have given the combined answer for all the shareholders. Anjali, FVC, no. No, 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 Anjali. You are doing some mistake. Yes, Ambika. EFOS is correct. What about capital gain, Ambika? Jayashree Lakshmi. Yes, perfect. Okay, let's try and solve it together now. So your reserves are issued. Reserves are there up to 3 lakhs, right? Now I'm talking about each shareholder point of view. So how many shareholders are there? There are 5 shareholders, right? They have received 2.60 lakh each. What would be the amount of reserve for 5 shareholders? My pen is not working somehow. 1 second. So what will be the amount for per shareholder of reserves? 60K each, right? So for single shareholder, out of 20.60 lakh, 60K will be taxed under 222C. Correct? 2 lakh will be your full value of consideration. Clear? And what is your cost? Share capital is 5 lakh. So your cost divided by 5 would be 1 lakh each. Right? Assuming you have purchased the share at the same price. So only 1 lakh will be your capital gain. This will be long-term capital gain because more than 24 months unlisted shares. Whether indexation would be applicable, the answer is yes. The indexation will apply in this case, but no information is given in the question. So we do not know what are the indexes, right? But indexation will apply in this particular case. Is it clear? And what will be the tax rate in this particular case? This will be taxed under 112. This will be taxed under 112, right? So 20% with indexation. Sorry, not 112A, 112. Or 10% without indexation. Clear? So this will be here, since we are claiming deduct indexation. So here we will apply 20% with indexation rate. So 20% will be applicable here. Is it clear? Did you understand this? 0.60K will be, 60,000 will be taxable under EFOS, under 222C. That will go as per normal rates. Clear? And from the company's perspective, company has sold the assets, but there is no information given at what price they had purchased, at what price it is sold. So we do not know what will be the capital gain in the hands of company. But when company is distributing it to shareholders under 46(1), there is no taxability. Is it clear? Clear? Any doubts? Did you understand this question? Yes, Jayashree. Ambika, yes. Correct, Leela. Ambika, you have written 2 lakhs as capital gain. Sorry, it's 1 lakh as capital gain and not 2 lakh. Clear, Ambika? 2 lakh was full value of consideration. Padmanaban, the excess realization which is there is the cash lying with the company. So you do not have to deal with it. There is no capital gain implication on that. Padmanaban, clear? Is this section clear? Any further doubts? Shall we proceed further? Now, there is a one question on this. Let me ask you further on this. So, this is a question from your module itself, wherein a question is asked that the shareholders are intending to invest the amount of capital gain in specified assets for claiming the deduction under 54EC or exemption under 54EC. 54EC is what? 54EC gives you the exemption only when you invest in certain specified assets. Now the question here arises, whether in this particular case, can you claim the deduction under 54EC? So there is a decision of Rajasthan High Court wherein they have said that exemption of 54EC is available only when there is an actual transfer of capital assets and not in the case of deemed capital gain. So here, if you notice, there is no actual transfer. I'm not actually transferring my shares. It's the shares which are getting relinquished. The company itself is getting liquidated. So it's a deemed case of transfer. So when there is deemed case of transfer, the court said that exemption under 54 EC cannot be available. Is it clear? Is it clear? So that's what they have held it in this particular case, that it is only available in the case when there is actual transfer and not in the case of deemed transfer. Clear? Any doubts with respect to this? Now the 54 EC is available only when there is a transfer of long-term capital asset being land or building or both. But this was in the earlier context when this decision was rendered. Clear? Any doubts? Any doubts with respect to this? Anjali, did you understand why we cannot claim 54 EC? Okay, so now let's proceed further to another important section if there are no doubts. Buyback of shares, section 46A. Now, this section 46A was earlier applicable to the listed companies. When they bought back their shares, the capital gain was taxable in the hands of the shareholder. Right? Now, from 2019 onwards, what they have done is section 115QA is applicable. 115QA is applicable on buyback of shares of listed plus unlisted companies. Listed plus unlisted domestic companies. And there the tax rate is 20%. Consequently, in the hands of shareholder, the income is exempt under section 1034A. So this is in the hands of company. So then, what is the importance of 46A in that particular case? 46A will only apply in case of buyback by other than domestic company, meaning the foreign company. So other than the domestic company, if there is a foreign company, then in that particular case, say for example, the foreign company, when its poem is said to be in India, and if it does buyback, then 46A may apply. Because for domestic company, this particular provision is applicable and the taxability is in the hands of company itself. Under 46A, taxability will be in the hands of shareholder. Clear? Or in case of specified securities for any company, whether listed, unlisted. If it's a case of specified securities, then 46A will applicable and not 115QA. What are specified securities? ESOPs. So on buyback of ESOPs, 46A will be applicable and the taxability will be in the hands of shareholder and not 115QA. Are you clear with that? So in that particular case, what will be applicable? 46A. So this is the chart for that. So buyback of shares of domestic companies, 23.296%. Buyback of a company other than a domestic company, taxable in the hands of shareholder. Buyback of specified securities, it will be taxable in the hands of shareholder and not in the hands of company. Clear? Is it clear? Any doubts till now? Any doubts? Any questions? If not, I'll quickly move ahead to some of the smaller sections of specific charge itself. So now let's go to the capital gains on various instruments. On various instruments, so there are different instruments and for them different rules are applicable. So first I'm talking about capital gains on conversion of debentures into equity shares. So what happens when the debentures are converted into equity shares? What is happening is the debentures from one form of asset is getting changed into another form of asset. So ideally there is no income involved in it. It's just from one form you're changing the asset from one form to another form. So therefore this will not be regarded as transfer under section 47(10). So conversion of debentures into equity shares is not considered as transfer under section 47(10). When the equity shares would be sold, what will be the cost of acquisition? The cost of acquisition, because you have not paid for equity shares. What you would have paid is for debentures. So what would be the cost of acquisition of equity shares when finally equity shares would be sold? This would be the cost of debentures. So cost of acquisition of equity shares would be cost of acquisition of debentures. This is as per section 49(2)(a). Clear? What would be the period of holding when the equity shares would be sold? What will be its period of holding? So the period of holding of shares would include period of holding of debentures also. Period of holding of shares would include the period of holding of debentures also. Is it clear? Whether indexation would be applicable from the holding of shares or holding of debentures. So indexation would also apply from the holding of debentures. Is it clear? Similarly, on capital gains on conversion of preference shares into equity shares. In this case also, this would not be regarded as transfer under section 47. And what will be the cost of equity shares? Again, the cost of acquisition of shares would be cost of acquisition of preference shares. What will be the period of holding in this particular case? So period of holding of equity shares would include period of holding of preference shares. And so is the indexation period. Clear? Is it clear? Any doubts with respect to this? Did you get this? Any doubts? It's clear. Let's move little further. What will be in the case of redemption of preference shares? Whether this is considered as transfer under section 247. Redemption of preference shares by a company comes within the definition of transfer because it's a relinquishment of asset. Right? So as per case law of Anarkali Sarabhai, Supreme Court judgment, redemption of preference shares is a taxable transfer. What about redemption of bonds? Again, this comes within the definition of transfer because redemption of bonds is also relinquishment or extinguishment of a right in that asset, and therefore this is also considered as or extinguishment of a right by operation of contract, relinquishment of a right in asset. Here also it's a relinquishment of not the asset but a right in the asset. So this will be considered as taxable transfer. Clear? This is as per the judgment of Parvich Wang Chuk Basi. Clear? Whether reduction of share capital, will it be considered as transfer? Whether reduction of share capital would be considered as transfer? Again, reduction of share capital is resulting in extinguishment of proportionate right in share. Held by shareholders. Right? So even this will be considered as transfer. And this is as per the judgment of Kartikeya Sarabhai. So redemption of preference shares is as per Anarkali Sarabhai and reduction of share capital is as per Kartikeya Sarabhai. Is it clear? So these are some of the things you will have to remember, could be there as a part of MCQs. Any doubts till now? Any doubts you have? If there are no questions, let's take a small break of 15 minutes and we get back after that. Let's quickly take a small break. Yes. So, any doubt, students, or shall we proceed further? If there are no further doubts, let's proceed further. Now there are small instruments which I would like to cover up with you. Let's discuss those before we move on to the important section. So sovereign gold bond schemes, this is again one of the instrument, and to provide the parity between the physical gold and sovereign gold bond, on redemption of the gold bond, there is no transfer. So redemption of gold bond is exempted from the definition of transfer, because what happens is when you redeem your gold bonds, you get physical gold in hand. So to incentivize gold bond schemes in comparison with the physical gold, this particular exemption has been granted. That means what? That redemption of gold bond would not result in any transfer. Is it clear? But there is another scheme of government. I'll tell you. So interest on, there are two schemes: sovereign gold bond scheme 2015, and then there is gold monetization scheme 2015. Okay, so interest on sovereign gold bond scheme is taxable, whereas it is exempt in case of gold monetization scheme under section 10(15)(6). The capital asset this is treated as capital asset, whereas this is not treated as capital asset itself. Transfer, here it is an exempt transfer, as I said, under section 47(7)(c). And since this particular gold monetization scheme is not considered as asset itself, no question of transfer or no question of taxability. Clear? Because it's not a capital asset. Is it clear? This you can get it for MCQs again. Then another one is rupee denominated bond. For rupee denominated bond, transfer of a rupee denominated bond issued outside India by one non-resident to another non-resident will not be considered as transfer under section 47. So these are bonds which are issued to the non-resident and which are denominated in rupees. So these kind of bonds, if it is issued outside India by one non-resident to another non-resident, the transfer is happening, then in that case it will not be considered as transfer under section 47. Clear? Also, appreciation of rupees which is happening against a foreign currency which is invested at the time of redemption of rupee denominated bond shall be ignored for the purpose of computing full value of consideration. So that appreciation amount will not be included, because when you would have purchased, the price would have been something else, and when you are selling, the price would have been something else, right? The rupee appreciation. So if it has been invested in foreign currency and the value of the rupee is in changing over time, then that shall be ignored for the purpose of computing full value of consideration. Clear? Then next is consolidation of plans within a scheme of mutual fund. Again, that will not be considered as transfer when the plans within a scheme are consolidated. Cost of acquisition will be the cost of the previous plan, and period of holding will also be clubbed of the previous plan. Clear? These are some of the small particular instruments where the capital gain taxation is dealt with. Then rights and bonus shares. With respect to rights shares, when you get the right to subscribe to the shares, there is no amount paid for that. You are just getting the right. Clear? When you renounce the right entitlement, when the right to renounce entitlement by purchasing the rights is renounced, again the amount paid would be nil, because you are just renouncing it. There is no cost involved in it, right? So when the entitlement to rights shares is renounced and you are purchasing the rights renounced, then the rights which are renounced, there is no cost attached to it. Shares acquired by purchasing the rights renounced. Shares acquired by purchasing the rights renounced, cost of the rights shares plus the price paid by the renounce to the renouncer for acquiring the shares. So when you purchase from somebody who is selling you the right, that time it will be the cost of the right shares plus the price paid by the renouncee to the renouncer for acquiring the shares. Clear? So when you are renouncing the shares, there is no cost involved in it because you have not purchased the right shares. Clear? Bonus shares, if allotted before 1/4/1981, FMV as on 1/4/1981. Clear? Now, this 1/4/1981 would be read as 1/4/2001 because the base year has been changed to 2001. And in any other case, the cost of acquisition of bonus shares would be taken as nil. Clear? Intangibles, goodwill of business, trademark or brand name associated with a business and or right to manufacture, produce or process of any article or thing is nil. Goodwill of profession is not applicable. There is an important judgment of B.C. Srinivasa Shetty. What does this judgment say? What does this judgment say? So, in this particular case, the Supreme Court was dealing with a case of intangibles or trademarks. Now, intangibles or trademarks are self-generated asset. These are known as self-generated asset, like goodwill. So, they do not have any cost paid like other movable, immovable assets, like other tangible assets. There is no cost paid unless the cost is paid for acquiring the goodwill. These are self-generated assets. Now, when these are self-generated assets, the cost is not applicable because I have not incurred any cost. It's a goodwill which has been created over time. Goodwill is what? Something which is perceived as a market value of that particular company. So, Supreme Court was concerned with this case wherein the assessee was asking that in case of sale of goodwill, there is no cost on it and therefore the cost shall be not applicable. And since the cost is not applicable, so the computation provision itself fails because you cannot from sale price subtract some amount which is not applicable. So the result will be not applicable. So when the computation mechanism itself fails, the charge cannot be created. Supreme Court accepted the contention of the assessee. It said that here you cannot compute the value of the goodwill. You have not paid any cost on it. There is no cost attached to it. So therefore, in the case of goodwill, the cost of acquisition shall be not applicable. To override that judgment, amendment was carried out under section 55. What does it say? Cost of acquisition shall be nil and not applicable. Now, what will be the difference between nil and not applicable? With not applicable, you will have no capital gains because you cannot compute the capital gain itself. But with nil cost, Entire amount of sale will be your capital gain. Entire amount of sale will be your capital gain. So therefore, in that particular situation, for business, for goodwill of business, Act specifically says that cost of acquisition shall be nil. But for goodwill of profession, it is still not applicable. Clear? Is it clear? Any doubts? Ambika, I'll ask them to upload it today again if they have not. Any doubts? Any questions? Is it clear? This much understood? Shall we do a sum on rights share? Did you understand the rights shares concept? What will be the cost for rights shares? Let's try and do a sum on that. So here is the question for you. Mr. R holds the shares in Star Miners Limited, an unlisted company acquired in the year 2001-2 at a cost of rupees 75,000. He has been offered right shares by the company at 160 per share in the ratio of 2 for every 5 held. He retains 50% of the rights and renounces the balance right share in the favor of Mr. Q. All the shares are sold by Mr. R for rupees 300 and Mr. Q sells his shares in December 2020 at 280 per share. What are the capital gains? So you are required to tell me the answer for this. So tell me the answer. Tell me the answer for this. What will be the answer in this case? For rights shares, what will be the period of holding? For rights shares, what will be the period of holding? From the date of allotment of such shares, the period of holding shall be considered. So where the share is subscribed by the assessee on the basis of right to subscribe, the period shall be reckoned from the date of allotment of such share. Where the right to subscribe is renounced, then in that case, the period from the date of offer shall be reckoned. So when the right to subscribe to any share or security which is renounced in favor of another person, then the period will be from the period of date of offer. Clear? What will be your answer in this case then? Quickly tell me your answers. Quickly compute the answers. Quickly tell me the answers. Ambika, your answer, you are saying first for 200 shares. I didn't get your answer properly, Ambika. No, it's not the correct answer, Ambika. Kunal has computed right. Chavi, no. Sumit, no. I didn't get it properly itself. Chavi, you have given only for one. For 1000 shares, you have given Chavi. Ambika, you have also given only half answer. Give me the full answer. Sumit, yes. No, Ambika. Somewhere you are doing mistake. No, Raman. Chavi, only part answer. Yes, Ambika. 6,000 correct. Yes. So in this particular case, let's see what has been done. First, 1,000 shares are there in an unlisted company at the cost of rupees 75,000. He has been offered rights shares by the company in the month of August 2020 at 160 per share in the ratio of 2 for every 5 held. He retains 50% of the rights and renounces the balance rights share in the favor of Mr. Q for 30. All the shares are sold by Mr. R for 300 per share. So first 1,000 shares, it's very simple. 300 per share they are being sold and it was purchased for rupees 75,000. And for 75,000 again, what they have done is they are saying that this particular 75,000 will be into 301 divided by 100. Correct? So this will be the case of 2,25,750 and answer will be 74,250. Is it clear till now? So here what you have to do is you have to multiply 75,000 into 301 divided by 100. Clear? Then 200 right shares which you have received, because for every in the ratio of 2 for every 5 held, and out of that you have retained 50% of the right and the balance are renounced in the favor of Mr. Q. So first we are computing for Mr. R. So in that case, 200 into 300 you have sold and the cost of acquisition will be 160 into 200 because it is paid at the rate of rupees 160 per share. Is it clear? Then next is sale of right entitlement. So you have sold the right entitlement at what price? 200 into 30 because that is what you are receiving, right? So in that case, the cost of acquisition will be what? It will be nil. Is it clear? And that will be your capital gains. Is the answer clear? So for the sale of right entitlement, the cost of acquisition will be nil. And the period of holding is taken from the date of rights offer to the date of renouncement. Clear? For sale of right entitlement, it will be from the date of rights offer to the date of renouncement. And for the balance, it will be from the date of allotment. Is it answer clear? Any doubts? Any doubts? Did you understand this question properly? How we have done it? And in the hands of Mr. Q, it is 18,000, right? The sale proceeds, he has sold for how much? 280 per share. And he has purchased for 200 shares, 30 rupees plus 160 rupees. So 38,000 will be the cost of acquisition and 18,000 will be the short-term capital gain. Clear? As it is for less than 24 months. Is it clear? Is it clear? Okay. So let's proceed further now. Now, as I said, for goodwill, it will be for the goodwill of business, it will be nil. For trademark, brand name associated with a business, right to manufacture, produce or process any article or thing, or right to carry on any business or profession, it will be nil. But only for goodwill of profession, it is not applicable. Clear? Any doubts till now? Let's proceed further to another important concept, very small one. ESOPs. Now, what will be the taxability on ESOPs? So, company gives you the stock options plan and you can exercise the option and purchase the shares of the company. It is just like rights shares only, right? So here, when ESOPs are exercised and when ESOPs are sold. So when ESOPs are exercised, it will be income from salaries. And this will be treated as perquisite under section 17(2)(6). Clear? What will be taxable as salary? Exercise price minus FMV of security. Clear? And when ESOPs are sold, then it will be capital gain. What will be the full value of consideration? The sale price. What will be the cost of acquisition? This particular amount, what you have already taxed. So FMV of security on exercise date. What will be your period of holding? Period of holding will be from the date of exercise. Clear? This is how ESOP's taxability will happen. It is just like rights share. Under the rights share also, we had the similar concept, right? So if I have to summarize the rights shares, it is similar like ESOPs only, correct? Under rights share, we have when we are exercising the right. Right? When we were exercising the right, the full value of consideration. So when we are exercising the right, that time the right to subscribe the shares, right to subscribe the shares is nil. There is no taxability when you exercise it. But when you sell this, sell the rights share, then your full value of consideration is sale price. Cost of acquisition is the right share purchase price or exercise price. Period of holding is still the date of from the date of allotment till transfer. Clear? And when you renounce the rights share, then the price you get will be your full value of consideration. Cost of acquisition is nil. So right to renounce is considered as nil. The cost of acquisition is nil. When this another person sale of renounced right, then full value of consideration is sale price. Cost of acquisition is equal to rights share purchase price. plus the price paid for purchase of right renounced. Is it clear? Is it clear? Are you clear with this concept? Any doubts? And what will be the period of holding in this particular case? The period of holding here is from date of offer till renounced. Period of holding is from the date of offer till the time it is renounced. Is it clear? And what will be the period of holding in the case when the renounced rights are purchased? When the renounced rights are purchased, then it will be considered from the date of allotment. Is it clear? Any doubts? Any doubts with respect to this? Any doubts? No questions? So shall I give you one more question on ESOP? Shall we do one more question on ESOPs? Let's do one more question on ESOP. What will be the period of holding for bonus shares? For bonus shares, the period of holding is from the date of allotment again. Mr. Raj, working with BNP, was awarded 5,000 equity shares at a discounted price of rupees 300 per share. At a discounted price of rupees 300 per share. The shares were vested on 1/4/2020 when fair market value was rupees 650 per share. Mr. Raj has decided to exercise option only on 1/5/2020 when fair market value was rupees 450 per share. Mr. Raj sold these shares on 1/7/2020 at rupees 700 per share. Compute the capital gains. Tell me the amount of capital gains in this case. What will be the capital gains here? Quickly tell me the answer. Yes, Kunal, correct. Leela, correct. Yes, Raman, correct. No, Ambika, why you are doing mistake in this? How you computed, Ambika? Tell me that. No, Ambika. Tell me what is your FVC, Ambika? What is your FVC and cost of acquisition? So in this particular case, let's do it together. What is the sale consideration? FVC 700 per share, right? So FVC is equal to 5,000 into 700, right? Which comes to 35 lakh. What is the cost of acquisition? So these shares were vested on 1/4/2020 when FMV was 650, and I decided to exercise the option only on 1/5/2020 when FMV was 450 per share. So here you have to take FMV as on the exercise date, which is 450. So 5,000 into 450 is equal to 22.50 lakh, and your capital gain, this will be short-term capital gain from the exercise date. If you see, what will be the amount? 12.50 lakh. Is it clear? Is it clear? Did you understand? Ambika, you have taken cost of acquisition wrong. It is 22.50 lakh. Did you understand, Ambika? Now, it will not be 7.5 lakh, Ambika. Is the answer clear? Shall we move ahead? Next, two small topics: corporatization and demutualization of stock exchange. Now, what is this? Corporatization of stock exchange. Now, what usually happens is when these stock exchanges, this is very old, these are very old provision when NSE and BSE were, getting formed. So usually these brokers have got the trading rights, right? These are very, very old provision, but they are still there as part of your syllabus. So usually the brokers who are there, they were members of the AOP. So the stock exchanges were usually formed as association of persons. Now, these brokers who are members provides capital contribution to stock exchanges. Right? Now, by providing the capital contribution, they get ownership, management, and membership rights. Correct? Now, these AOPs of stock exchanges are converted to corporate form. In a company, right? So this was there when NSE and BSE were not in the company form. So when these get converted from AOP to company form, in exchange of membership rights, the broker would receive the shares of the company. Now they had capital contribution, right? So they had only membership rights. Now, once these stock exchanges get converted to company, what will happen? They will get shares in exchange of their membership right. Now, this transaction of renouncing the membership rights and getting the shares in return falls within the definition of transfer. Correct? It falls within the definition of transfer. However, the Act says this is not specifically to be treated as transfer. As per the exemption is granted for this under section 47 13A. 4713A. So when the brokers would receive the shares in the stock exchange in lieu of giving away their membership rights in the AOP, this will be treated as exempted transfer. Clear? When the taxability would happen, the taxability on this would happen when there is sale of trading rights or shares. Now, what is this? When there are two aspects to it: sale of trading rights. When the broker will sell his trading rights to another broker, say for example, FVC would be amount received on sale. Cost of acquisition will be nil. Trading right is an intangible asset. Just now we learned for intangible asset, the cost of acquisition is nil. Are you clear? So in that particular case, for this sale of trading rights, cost of acquisition would be nil. Period of holding will be from date on which broker becomes member of AOP till date of transfer of trading rights. Right? So period of holding and indexation will be from date when you became the member of AOP. When you sell the shares of company, when you sell the shares of company, which is the stock exchange, what will be the FVC? FVC will be again actual amount received. Cost of acquisition will be capital contribution in AOP. Because you never contributed in shares. The shares were, the capital contribution in AOP was converted to shares. So cost of acquisition will be the capital contribution in AOP. Period of holding and indexation will be from date of becoming member in AOP. Are you clear? Did you understand this one? Any doubts? Any doubts with respect to this? Did you understand this particular provision? Any doubts? Okay. Next provision, again a very small provision, an old provision. Let's understand, because since it's part of your syllabus, I'm taking up, but those are not really that important provision. Reverse mortgage schemes. Now what happens in this particular scheme? Say for example, there would be, say, Mr. A. He is the owner of house property. Now he's very old, he needs some amount, he needs some monthly payment. What he will do? He will mortgage his house property with the bank. And in lieu of that, bank will give him monthly payments. Now these monthly payments, in lieu of giving your house property, are exempt under section 1043. Are exempt under section 1043. And this mortgage of house property is considered as not transfer under section 4716. Clear? So reverse mortgage schemes refer to that you mortgage your house property, you receive monthly payments, that will be also exempt, and it will not be considered as transfer also. Clear? What if Mr. A dies? Now, the legal heir of Mr. A, what he does is, he goes to the bank, he pays off entire amount, and he takes the mortgage property from the bank after repaying the amount of loan. Now, when he buys the house property from the bank, he thinks that it's no more required and he sells off. So, the heir of Mr. A repays the loan and buys house property from bank. Subsequently, he sells the house property. In this particular case, how will be the computation? Full value of consideration will be the amount received. Cost of acquisition will be cost to the previous owner plus loan repayment, the amount you have paid to free that house property. Clear? Period of holding will be from date on which asset was purchased by previous owner, that is Mr. A. So period of holding will also be clubbed, and even indexation will apply from the date when the asset was held by Mr. A. Are you clear? So here it is important to note that the cost of acquisition will be the cost to previous owner plus to free up that property you have make the payment of the loan, so you will get the deduction of the loan repayment also. Clear? Is it clear? Any doubts? Any doubts? Any question? So MCQ may come on this. Any questions? Shall we move ahead? Sumit, at the stage of alienation, as in you are saying about the legal heir perspective, or what you are saying? Alienation when? When you are asking about the alienation? Okay, let's move ahead. Now, this is what we have learned about different capital gain on different assets or different transactions. Now I'm getting into the computation mechanism. So now, first of all, computation of capital gains. Section 50 talks about capital gain in case of depreciable assets. How will you compute the capital gain for depreciable assets? So only when the sale consideration is greater than WDV in that case, and second, when block ceases to exist, only in those cases capital gain will arise. So when your sale consideration is greater than WDV, meaning your block has become negative, or block ceases to exist, meaning there are, or I can say all assets in the block are transferred. All assets in block are transferred, then there will be capital gain. Are you clear? So how will that computation be made? How will the computation be made? So usually you have the block of asset for depreciable asset, right? So for every block, you don't need to consider asset wise, you consider block of asset, like entire plant and machinery, entire amount of furniture, you take it into one block, right? So capital gain arising on transfer of a capital asset being depreciable asset shall be computed with respect to the block of assets, right? And how will you compute? So say for example, you will have opening WDV, add some additions during the year, right? Clear? Then less sale during the year, only when your block becomes negative, there will be capital gain. Is it clear? So in this case, this will be on depreciable asset, the gain will be always short-term capital gain. The gain will be always short-term capital gain, right? So when will the capital gain on depreciable asset arise? When there is the sale consideration is exceeding the WDV, meaning the block has become negative, or the block ceases to exist. All the assets in the block are transferred. In that particular case only, there will be capital gain. If, say for example, say this is 100, this is 150, right? And this will be say 300. So the block has become negative, right? So in that case, 50 will be your short-term capital gain. But say for example, if instead of 300, this is 100, then 150 is still lying in the block. 150 is still lying in the block. If there is a positive value in the block and not all assets in the block are transferred, you will claim the depreciation on 150. Are you getting that? So here, depreciation will be claimed on 150. But say for example, if there were, say there was this one asset, there was this two asset, and all the three are transferred, but still there is a value in this block. Will you claim depreciation? Answer is no. Here, this will be short-term capital loss. If all the assets are transferred, no further depreciation will be claimed. But say for example, if only year 1 was transferred, then on 150 depreciation will be claimed. Are you getting that thing? Is it clear? Any doubts with respect to this? Sumit, no. When bank will recover loan, that time there is no alienation. Alienation happens when you are selling off that asset. So the question is, what will be your cost of acquisition? It will be cost to the previous owner plus the loan repayment amount. Clear, Sumit? Is it clear? Okay, let's proceed further. So this was with regard to depreciable asset. For other assets, the computation is provided under section 48. What does section 48 says? Capital gain in case of non-depreciable asset. You have long-term capital gain and you have short-term capital gain, right? That depends on your period of holding. For long-term capital gain, how do you compute? Full value of consideration less expenditure on transfer less indexed cost of acquisition, indexed cost of improvement, and this will be your capital gain. From this, you less exemptions. Right? How do you compute short-term capital gain? Full value of consideration less expense on transfer and cost of acquisition and cost of improvement. Clear? So this is your short-term capital gain and less some exemptions if applicable. Clear? Now, there are different provisos to section 48, which talks about the computation. First and foremost thing, the taxability happens in the year when you receive the amount. So say for example, you have received only part installments. You are receiving the amount in installments. So say for example, your total consideration was 100 and you are receiving part in 5 installments. So when you receive the first installment, in that year itself, entire gain will be taxable. It's not the case that only the part gain will be taxable in that year. So entire gain will be taxable in the year itself when you receive the part installment. Clear? Except we had seen the case of 45(5), compulsory acquisition of land. When you receive that amount in parts, that time the gain was taxable, but it was taxable only in parts. Clear? So there it was taxable and entire gain was taxable when a compulsory acquisition of land was happening. Entire gain was taxable even though part amount was received, but for enhanced compensation, it was in the year when enhanced compensation was received. Clear? Now, what are these provisos to section 48? The first proviso to 48 talks about exchange rate fluctuation. This I am not doing again because this I have comprehensively covered while doing international tax class, because this is applicable only to non-resident when you invest in foreign currency in the shares of Indian company or debentures. You get the exchange rate fluctuation. You convert all the value of shares in foreign currency, you compute the capital gain, you convert it to TTBR and TTSR average rate, and then you reconvert the capital gain into Indian rupees. Clear? Second proviso to 48. What the second proviso says? Cost of acquisition and cost of improvement shall be indexed. Cost of acquisition and cost of improvement shall be indexed. Right? So CII for the year in which the asset is transferred divided by the CII in which the asset was purchased or was first held by the previous owner. Right? So previous owner's period also you include it. Third proviso third proviso, it says that benefit of indexation, that is second proviso, and exchange rate fluctuation is not applicable to sale of listed equity share or unit of equity oriented fund or business trust. So on sale of listed equity shares or unit of equity oriented fund, indexation benefit and first proviso to section 48 will not apply. Clear? That we shall deal in the next class. And fourth proviso talks about indexation will not be applicable in case of bonds or debentures where first proviso is applicable, that is shares of Indian company acquired using forex by non-resident, depreciable asset, slump sale, and GDR sale by FII in forex. Clear? So fourth proviso talks about when the indexation benefit will not be available. So when first proviso is applicable, second will automatically not apply. To bonds and debentures also, depreciable assets, slump sale, and sale of GDR or sale of units by FII. Clear? Then fifth proviso talks about STT is not allowed as deduction. Remember that day we were dealing with a sum of sale of stock in trade, conversion of stock in trade to capital asset. There we had taken the deduction of STT while computing PGBP, but we had not taken while computing capital gain, because fifth proviso talks that STT shall not be allowed as deduction. Is it clear? Any doubts? Padmanaban, proportionate depreciation to what? Do you have any doubts? Any questions? If there are no further questions, we can stop here for today. I'll share you the notes. Chavi, you are asking what will be the cost of acquisition under section 45(1)(a) related to insurance receipt. Chavi, it will be the cost at which you acquired the asset. Clear, Chavi? Is it clear, Chavi? See, here I had done it. insurance compensation received was 60 lakh. Cost was the cost of the asset at which the asset was purchased. Clear, Chavi? Any other doubt? Perfect, Chavi. Padmanabhan, you are saying when assets are sold in between the previous year, will not proportionate depreciation as per IT rules provided. No. Padmanabhan, it's like an entire block. You have to decide the depreciation after you reduce the sale consideration. So there is no concept of proportionate depreciation. You get only depreciation at the half of the rate if you purchase for less than 180 days. If you purchase for more than 180 days, you get the entire depreciation. So irrespective of the day when you have purchased, only if it is for less than 180, you get half the depreciation rate. But that also you decide once you reduce the sale consideration. If the block turns negative, then you will not get any depreciation. Clear, Padmanabhan? Any other doubts? In next class, we will start with 112A, which is very, very important. So first you revise all of this, what we have covered in this class. So I'll see you in the next class. Thank you.